Welcome everyone to the Black Bull Markets webinar, 12th of April 2023. It's 11 a.m. in New Zealand here. I'm just going to share my web camera so everyone can see me. My name is Anish Lal. If you haven't been introduced to me so far, I'm the Chief Business Development Manager here at Black Bull Markets. Straighten up my tie. And yeah, host the webinars here and to assist everyone, I guess, with trade strategies. We've hosted webinars about risk management, about getting started with trading, about forming successful trading strategies. So we're going to crack into the next one, and this one today is about scalping or swing trading. Now, it's a common question that we get asked a lot by traders is, hey, what strategy generally works best for me? And of course, this webinar is going to discuss the pros and the cons of all these different strategies. Firstly, it's important to note that we can't offer trade advice, but we can discuss market color, we can discuss my previous experience, my personal taste, and also discuss your questions through the question panel. So throughout the course of this webinar, please do use the question panel. We'll have a little Q&A session towards the end of the webinar so we can get through all of the questions. If there's anything urgent you want me to answer, just put your question in there as well, or send me a private message, and yeah, we'll get to it and discuss. So the first thing to note is that markets are just opening up on the metals markets. That is, the FX markets have finished a settlement and were open up 2 hours ago. So hey, let's just look into some markets then. As you can see here, we've got gold. Now gold on a 5-minute time frame. So we'll just generally start with some market color. It's been a bit stagnant over the last 24 hours, unlike, of course, last week. This is a 5-minute time frame. If we just skip to an hour time frame, see, last week we had a huge rally all the way from around 1980 to those 2030 highs, and those are previous highs that we pointed out on a weekly chart, and even going back to a monthly chart, almost getting a triple top formation there. If we take out our market watch window, you can see where those tops. Oh, apologies, we've got no audio there. Let me just if anyone else can't hear me, please do let me know. We can just switch around the microphone. Testing. Can you guys hear me? Anything in the questions panel? I think it's Grant. Grant, if you can't hear me, please do let me know. I've just changed my audio settings up. It's showing that it's displaying, so let me know. Anyways, we'll get back into it. So you can see this triple top, and that triple top. Can you guys hear me? Yep. Okay. I can hear myself on the webinar, so it should be good. We'll just get back into it. So that triple top on that monthly chart really holding a real strong resistance level on gold, and we are seeing some sort of stagnation if we drop to the lower time frames. So that lower time frame is kind of hovering around the $2,000 an ounce mark, which is a key psychological top, but also a pretty risky place to be for gold. Especially if you're selling gold, you might be wary of those shorts, as to the upside, you do have a target here just below the $2,070 an ounce mark where that wick formed, and the previous wick as well, of course, during that pre-COVID sell-off in the equity markets, a rush to safety. We discussed this in the video yesterday. But yeah, it's a really interesting market to watch. Now, why am I talking about this? Well, we're talking about this because we want to identify what strategy potentially could work for you on this market. Now, essentially, you've got your swing trading and scalping. Now, what are the differences? Firstly, The difference is generally that scalpers like to trade short-term market moves. That could be at predetermined prices, that could be generally on lower time frames, but usually you're looking for about 20, maybe 10 to 20 pips to the upside, especially if you've got really good spreads, like we do. And then you can, keep a nice tight stop loss in, hit your 10, 20 pips to the upside, and you're out the trade. Now, generally, that's what scalping is about. So just as an example, if you were to place a trade on gold right now, say you're looking for 10 pips to the upside, you'd be buying the market, you'd be wanting to put your take profit around the 2000, I believe it's the $2004 mark, and then if you want to keep a real tight stop loss, it'll be 2003.10. Now, this methodology of trading is pretty high risk, but if you're trading breakouts or say buying pullbacks or selling tops that you've identified, say on higher time frames, and you just want to capture that short market move or during a news event, it could be pretty effective. So if we go through an example, let's try and go through a scalping trade example on gold. On gold. So what I like to do is always start on a higher time frame to identify where the trend is. And as we, from our previous analysis, you can see that on the weekly time frame, we can see that gold's pretty toppy at the moment. And around that $2,000 mark an ounce, there is a bit of resistance here. And if you go from the weekly time frame and you skip to the daily time frame, you can see again you've got a little crosshair candle, which could also indicate a bit of a short-term reversal in the trend. Now, there's not really much though to go by on here, just purely because the momentum has really slowed down on gold. But say if you were confident enough to take a little scalp short, because you feel that perhaps $2,000 at this stage is a bit toppy. Of course, you've got US inflation data coming out later on this week. Maybe markets are just sitting on their hands, waiting for that data to come out before, there is another leg either to the upside or downside. But it's important to know, of course, that when you're trading, you don't really want to just get onto the market and place a trade. That's impulse trading, which is relatively high risk. It's always about assessing opportunities, assessing potential entry points, and then making trade decisions. What I'm doing here, though, of course, is just an example. Let's. There was just a question that came in. It's good to know that the audio is working. So, is scaling suited for scalping? Potentially. That really is kind of, Chris, letting your winners run, for example. So, in that case, you may not want to have a take profit in place. But through these scalping examples, we're going to talk about placing very, very short, sharp, sweet trades with small take profit levels and even smaller stop losses. So we're going to run with a 2-to-1 risk to reward ratio here. And just as an example, we're going to just place a trade. And we're going to sell. In this example, we're going to sell at market execution. We're going to trade one lot of gold, which is of course 100,000 units, and what we're going to do is place our stop loss 10. We're going to go 10 pips below, or rather above the market price. So current ask is 2003.81. So we're going to go 2004. I believe 91. Should give us 10 pips. And similarly for the take profit, apologies, for the take profit, we're going to go 20 pips to the downside. So we're going to go 2002.83. So if we sell this market now and we open up our order window, that's our navigator. So of course, to open up your terminal, you would hit view, and then you would find your toolbox, and through your toolbox you can see the price that we placed, and I've actually entered a 1-for-1 ratio. So let's just change that quickly and represent the actual 2-to-1 ratio. So we're risking essentially $20 to make $40. So we just change that up, and we'll see our stop loss. Now it's a daily time frame, so on the chart you can't really see it, but if you skip to your lower time frames, you can see our entry levels on this trade. So if you hover over here, we're just above the 10 pips. Markets may have moved, and we've got a $300 take profit. But again, we can move this around to represent exactly where we want to be. So this is probably a bit easier on the MT5 platform, where you can schedule in where you want to go. So we're going 200 and we're going 400. There you go, that's better. Apologies for that confusion. Right, so let's start again. We've placed a trade, we've sold the market. Now we've started our analysis on higher time frames. Now we're skipping down to lower time frames to action our trade and to monitor our trade, because typically when you're scalping, you're looking at these lower time frames after analyzing higher time frame moves. Now this of course was more of an impulse trade, but more of an example just to show you guys how it works. This is a strict 2-to-1, risking $200 to make 400. I mean, this works. Yes, it does. So 200 to make 400. Our take profit and our stop losses are placed here. Our stop loss is at $2,005 an ounce. Take profit is just below $2,000 an ounce. Current market price is $2,003 an ounce. So what we can see is that if the market moves, of course, 1 pip to the downside, we're up $10. Currently, we're just paid for the spread. The markets have just opened, so it is a low volatile, low moving market at the moment. Pretty stagnant, as we've seen even over the last 24 hours. But just as an example, that is really what a scalping strategy and the essence of the scalping strategy is. We're looking to place these types of trades during high volatile, high moving market times. So for example, during news events or during times where you see scalping opportunities through fast moving markets, as what we saw last week. So if we go to a 4-hour time frame, for example, or even a daily time frame, you can see the way gold has been moving over the last week. It's been pretty phenomenally moving to the upside. So if you were to recognize opportunities and look at scalping those positions, that's what you could get into. So just some technical analysis here. We're looking at an upward trending market. What I like to do, now this kind of translates into the next step, which is our swing trading strategies, but it's more of a combination of both for the analysis, what we can use for moving averages. So I've got a 50-day and I'm going to stick a 21-day as well. And we're going to use 2 different colors so we can see these easily. And as you can see, just on the 21-day moving average, we're seeing markets well supported there throughout the course of, this is of course a daily time frame, throughout the course of latter part of last year. And essentially, this could also give you a signal for scalp opportunities, where really if say you're looking at buying the market, I know we've sold on this occasion, but if the candle hit 1957 around that mark, that could give you an opportunity to say, hey, look, this is where I'm going to look at buying the market. You can put in an order. I did a market order before, but you can actually place a buy limit on that occasion, and then that buy limit will essentially give you the an opportunity for scalping. So scalping doesn't always have to be limited to, hey, I'm looking at the chart, I'm going to place a trade now. No, you can actually have a predetermined scalp order in the markets using that 2-to-1 risk to ratio that we had in place at predetermined price levels. And that can even be applied to lower time frames. So you can see as you go lower down the time zones, you can see the moving averages are pretty much in a confluence region, pretty sideways. So it's more difficult to assess this perhaps on lower time frames. However, if we get onto the swing trading topic, that kind of works a little bit better when we're talking about moving averages. So just before we get onto that, just going to go through his questions. I see them all coming in here. So Chris has asked, what is your leverage? Well, the leverage on this account is actually 500 to 1. This is a live account in the live environment. It's got about 60k in. Again, just going back to that scaling question that you had, say for example, we're in this short now for gold, and prices in fact did move to the downside, and we didn't have a take profit that existed. So you could potentially, depending on your risk appetite, start to, if markets do start to move here to the downside, you could look at moving your stop loss even closer to your entry level to lock in a lot of those profits or minimize your loss and place more orders to buy. But that all depends on your risk management and how much you as a trader have an appetite for risking on any particular trade. That's so important when you come into trading, because for me, for example, okay, I placed a scalp trade. That's my only trade that I'm going to place today, and my rule of thumb is that I'll do a maximum of 1 trade per day. That's 5 trades in a week. All I need to do is hit 2 out of those 5 trades to be successful. If we just simply go through the maths on that, if we're risking, say in these examples, $20 to make $40, if you've got 5 trades that you've placed on a week, say Monday, Tuesday, Wednesday, you've lost all those 3 trades, which means you've hit your stop loss on those 3 trades. You're in fact down $60, right? But say on Thursday and Friday, you've got 2 take profits, bang, bang. That's $40, $40, that's $80. That means at the end of the week, you're $20 net profit, and your aim is to have some sort of alpha profit by the end of your trading period. Me personally, I look at a week trading period. If there's not an opportunity on the cards, we won't trade on that day. That's fine. But generally, if I'm looking at trading every single day or finding some sort of opportunity, doesn't matter on what asset or what I'm trading, as long as I've got a risk to reward ratio that's inbuilt in my strategy, that means it doesn't matter if the markets hit my stop loss and I'm out. I still know that probability is on my side. All I need is 2 out of 5 in the week, which is even less than a 50% success rate. Then at the end of that week, I'm still making money. That's basically a rundown on risk management and how you should adopt that, whether you're scalping or swing trading. Now let's get into, that's the scalping example. Like I said, scalping, if you're looking for short-term market opportunities, if you're at your charts, you do have that bit of impulse, even though it's not recommended. You want to wait, you want to look at opportunities. You don't need to trade every day. You can just wait for opportunities or just trade around high volatile moves. That's essentially scalping. Scalping strategies are mainly, for people that generally, or traders that like that more instant gratification. I guess sometimes when you do trade, there is a mix. Ultimately, you want to get to a perfect balance of mix of trading strategies. But if you're looking at short-term market moves, you're in, you're out, you're off your screen, it's out of your mind, you're done. Like that also helps psychologically speaking as a baseline to support your strategies. Let's get on to swing trading. Now, as we've already done, we've already drawn these moving averages. Now, as we've got a question on moving averages, how do we look at moving averages? Well, just a bit of context around that question. Just what I think you're asking is, what I've done to enable a moving average is I've gone into the platform, I've hit insert indicators, it's a trending indicator, and then you simply click moving average, you enter the time period, and you click OK. In my example, now this is one of my favorite strategies. I've discussed this a lot through all my webinars and tutorial material. I like it because it works well, it's tried and tested. You're trading with the trend. If you want to trade against the trend, you have some clear parameters as to general benchmark prices where you want to kind of put your stop losses and take profits. It's a really good guideline for me personally that helps me with my risk management. Now, swing trading, just as the base example, just means that, hey, you're swing trading, you're holding a trade overnight. Essentially, that exposes you immediately though to overnight risk. Overnight risk is derived from market close, because essentially when you're trading, say, gold, the market's closed for an hour for settlement. Similarly with FX, it's actually closed for 5 minutes before the midnight clock on GMT for settlement. So market close equals risk for market gaps. Historically speaking, including the weekends, of course, if you're holding a trade over the weekend, historically speaking, for example, SVB recently crash was declared on a late Thursday, Friday. Officially bankruptcy occurred over the weekend. That, of course, led to a market gap on gold. So those types of events you'd have, if you wanted to kind of stay clear of kind of that overnight risk, you wouldn't want to swing trade if that's not within your risk appetite scale. Swing trading, though, overall, mitigating all those shock news announcements, is very good if you're looking at kind of long-term vision for your trading. For me personally, my aim is to not measure profitability in a week, not to measure it in a month. I look at quarterly profits, I look at annual profits, even biannual profits if needed. Now, the aim is to generate something that's more positive than the banks. That is the most realistic outcome for trading, in my view. If you're making 1 to 2% a month, that's amazing. That's 12 to 24% per year. That's such a great return on investment. And if you do that consecutively or consistently throughout the year, okay, you're going to have more. You're going to have losing months. You're going to have positive months. The idea is to generate some sort of alpha that's greater than the interest that you're earning at the bank. If you can do that, you're then making your money work for you. Now, the question is, how do you do that? Well, firstly, it takes a lot of time and education, and that's why we're providing these webinars, to give you some sort of fast track access to understanding the fundamental principles of trading. Risk management is number one. Where do I place my stop loss? Where do I place my take profit? Well, we're telling you here, of course, not trade advice, but something you need to look into. Look into a risk to reward ratio that works for you. Swing trading allows you all of that. Swing trading allows you the ability to, hey, place a trade, let it run, and let it hit your target. It could be a long-term target that you have in mind, or it could be, and you know what? It doesn't matter when it hits, but essentially you've got that overnight risk to consider. And these moving averages, trending indicators, assist you with that strategy. So if you like to trade with the trend, if you like to understand, if you like to have a base strategy based off these moving averages, this is where a strategy like swing trading comes into hand. And we're going to talk about things like swaps as well down the line, but let's just go through an example. Right now, you've got your moving average indicators. Essentially, what the 21-day crossing the 50-day moving average signals is a buy signal. As an example, if you were to buy the market 1675 on the 15th of November 2022. Of course, this is all back testing here, but essentially the back test is, your assurance testing for any future trades. 1675, and you close it at 1866. That's when those moving averages cross over again. That's an 11% increase on that trade value, and that's essentially over nearly 2,000 pips on that trade. So that trade duration would have been from November to February. So that's almost 4 months. That means you've got to be prepared to hold a trade for 4 months. What does that mean? Well, you've got to have a strict stop loss in play, and you've got to probably create some sort of dynamic policy with regards to your stop loss. That's essentially a swing trade example using these moving averages. Now, these moving averages are an indicator as to where to buy, where to sell based on a trending market. Say your 50-day crossed here and crosses again here. You've actually lost money on this trade. So if we're just back testing the last 4 to 5 months, you would have lost, again, similarly, about 229 pips on this trade. But it doesn't matter if you've been following it from November to March. You're actually still in profit, and you've got a new buy signal, which technically, if you've been following this strategy strictly, you've got a buy signal here, and the buy signal is still holding. So you're still in a buy trade for gold. Now, what's important to note is when you do use a strategy like this, you're buying and selling using stop losses. So even though you've sold the market here, you would have either closed when the moving averages closed again, or you would have had a stop loss in place, say just above your 21-day moving average, and you would have either been stopped out at around 200 pips, or you would have had to close manually at the cross. That's the essential guide of the moving average crossover. Now, what is the risk? What are the costs involved for me holding a trade? Firstly, it's important to note that it's good to start with this strategy by trading small, back tested across a few different assets. That's gold. But if you wanted to find out, hey, exactly what's my cost to holding this trade? Well, what we do is we bring up our market watch indicator. We're going to hit the specification tab, and this is going to give us a bit more indication about our cost of hold. Now, this is the swap rates. This is from the swap market that you're trading. Now, of course, long positions are actually charged at 28 points. So if you're trading $1, it's about $2.83 USD per lot to hold this trade. So it is relatively pricey if you're holding across 3 to 4 months, for example. Those costs can add up. So it's important to account for those costs when you're trading. However, if you are shorting gold, now this is positive carry trading example, perfect example. Say if you want to sell the market, disregarding the moving average indicator you're selling, you're getting paid about 89 cents a night per lot for trading gold. So it's a positive as well as a negative depending on which direction you're going. If we just go to another example, let's look at pound dollar, for example. Again, does the moving average indicator hold for swing traders? If we stick to the daily time frame and we buy at a cross and we sell at the end of the crossover, well, yes, that's up again 7% in the value of the pound dollar. We just go back to that again. So you just grab your crosshair, take it from one cross to the other cross. It's 860 pips on that trade. Even if you're trading $1 a lot, 0.1 trade, a 0.1 lot size, that's still $860, or as a micro lot, which is $86. Whatever it is, it's still profit. Profit is still profit. Again, you want to be trading this strategy with a tight stop loss. Swing trading presents overnight risk. As I said, we go back to our market watch window, we look at the specification tab, we understand what a total cost for the trade is, and we hit our swaps, and we're actually again getting charged about 57 cents a lot. Or if you are to short the market, you're getting paid. Now, swaps, just as some background information, are predetermined swaps prices from the swaps market, which are derived from the interest rate differentials between the two respective central banks you're trading. For example, you're trading pound against the US dollar here. If you're selling the pound against the US dollar, you're actually selling the reserve rate from the Bank of England against the reserve interest rate from the Federal Reserve, which presents a differential, and your cost of borrowing that currency is X, and that is applied to your trade, whether you're buying or selling. That's essentially how a swap is calculated. All right, we've got a few questions here. It's coming to the end of the half-an-hour session. I hope that has been useful. We'll just go through some questions. If you're still following the webinar, thank you for following throughout the duration. I mean, it's a lot of information to take in. But essentially, if you go back and watch this, this is recorded. This will be placed on our YouTube channel, and it's definitely worth another watch, just as well as our other webinars to go through risk management. So yeah. Question from Warring. Yes, the webinar will be recorded. Is there a best strategy for squeezes? Chris, if you can provide a bit more information as to what a squeeze strategy is for you. It's something, unfortunately, I'm not too familiar with. Moving averages, we got through, and I think that's all. But if you're listening, we'll just keep the webinar open just for a few more minutes. And if you have any strategies, questions, let me know. As those questions come in, we'll just add a bit more market color as to what I'm personally looking at. Well, I'm personally looking at gold. I've got eyes on the US inflation data at the moment, looking for really the next value that gold can hold, and of course eyes on the tensions around Taiwan and China, because that any geopolitical risk fundamentally in this high inflation environment that we have at the moment is such a great excuse for gold longs to trigger again, take out that previous wick that we formed last week, 2000 and around the $2,030 an ounce, and then look higher at 2070. Now these wicks generally get filled during high volatile price action moves, so it's such a great one to watch. Me also, I'm an absolute lover of gold. The reason why is because gold fundamentally for me paints the picture of macroeconomics, and if you understand the fundamentals, if you understand the sub context behind these moves, it also helps you in your trading decisions, because you only really need to stick to one or two assets to form a profitable strategy over the long term. Gold is a great asset to do that with, because we do get good abidance by support resistances. Of course, it's an asset that's held across the world as a reserve, almost now the reserve back currency, as you've got this case of de-dollarization as well, more case for a gold run to the upside. But hey, let's see what happens. Trade consciously, trade with care, use risk management, keep following our webinars. I hope you enjoyed it, and wish you all the best. Take care.